Stocks sold off to end the month of March, and what a month it was. Of course, one of the worst months that we've had in quite some time. In fact, today was the last day of the quarter as well, and for the Dow Jones Industrial Average, this was actually the worst first quarter in history. It was down 23%. So I think many of us are looking forward to putting this quarter behind us and hopefully moving on to more constructive price action as time goes on. But obviously we still remain with a heightened volatility index at this level. We did see that the S&P 500 fell about 1.6% today, but that's actually considered a lower amount of daily range than what we had been experiencing. So we're going to take a look at all that, see what it means for our posture. We'll then look into a trade application example where I wanted to look at a dividend king, in other words, a stock that's raised its dividends for 50 years in a row. And it is a stock that is definitely much more controversial right now as a result of what is happening in the world around us with the coronavirus. We're going to see if we maybe have an opportunity to take a bullish trade on that with a very wide margin of safety. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 31st, 2020. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe on our channel, and then go down to our description area where you can sign up for our email distribution list. We also have a big presence on Twitter. We would encourage you to follow us there. My handle happens to be at Brandon Van Zee. And we do encourage you to click like and retweet on these Market Outlook related posts if you find value out of them and want them to continue on a regular basis. We also have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see, I have chart 6D pulled up in front of us. As per routine, whenever we have a 1% up or down day or more, we generally bring this up to try to give you a sense of where we stand with things and how aggressive of a move it was. Now, if you look at today's candle up above here, it was a very modest or moderate candle, but it was indeed more than 1%. It was 1.6% here on the S&P 500. That will then kind of make this red bar here below the zero line, giving us a sense of how dramatic, or perhaps in this case, not dramatic, a 1% move is. Remember that during this period back here from about October till about January, we only had one day that was more than 1% down, and that was here on December 2nd. So that gives you a sense that in that 3-month period, you hardly had any 1% days. Fast forward to where we're at right now, and it seems like a 1% day is kind of an afterthought, as we've had some moves that were as violent as this one here. Kind of the ugliest move that we saw was down, basically 10% here on March 12th. So we've certainly seen worse, is the point that I'm trying to make, even though today was an above average day from longer term history perspectives. Just recent history suggests that it was a fairly quiet day. Perhaps a little bit of window dressing going on there with some big fund companies trying to position themselves in certain stocks, as a lot of hedge fund managers and mutual fund managers will now have to send out their quarterly reports based upon what stocks did they hold as of today. And so some of them might have been rotating into, stocks like Regeneron, I noticed had a very nice day here. So it's REGN. This is one of the stocks that's vying for potential cure for the coronavirus, or a vaccination at least. Let me get some of these drawings off of here, and let me just remove that one and show you that we actually had a pretty solid day there for Regeneron. It was up about 3% right there. So that stock has been kind of one of those story stocks that maybe a lot of fund managers would like to show that they've owned. Whether they owned it for one day or for the last 2 months is another question, but at least for their clients, perhaps it'll look better if it appears that they own one of these stocks that's doing a little bit better than the rest of the market out there. So that's one example of a stock that did perform reasonably well here today. Let's get into more of our traditional charts now, and let me start here with chart 4. 4B, and this will be our market forecast chart. This is how we will use, or what we will use, to gauge our intermediate term posture. Remember, when we're looking at this particular chart setup, the green background color will tell us whether we have a weakly bullish posture or a strongly bullish posture. In the case of all four of our charts right now, you can see that they have that light green background color telling us that we do have a bullish intermediate posture, but it is considered weakly bullish. In other words, not strongly bullish, weakly bullish, and therefore could roll over fairly quickly. So in other words, if you're taking bullish trades based upon that bullish posture, make sure that you are position sizing appropriately, meaning conservatively, and or giving yourself a big kind of margin of safety. And so that's what I'll hope to accomplish at the end of tonight's video with our bullish trade. As most of you know, I've been doing bearish trades more often than not in recent weeks in this presentation because our overall market posture had been bearish. Now that our market posture has flipped to bullish, I will at least entertain a bullish trade idea at the end of the session, but it is going to be just kind of a quick little dip your toe in the water, not going head first, because I still am somebody who believes that we have a decent chance of retesting those lows at some point going forward. Whether that happens in the next week, in the next month, in the next 3 months is anybody's guess. But that is my baseline case right now, and I think a lot of people are kind of in that camp as well. So we'll see whether it happens or not, but right now I just feel like I need to be a little bit more cautious than I typically would be, because I do fear that this coronavirus news is going to continue to get worse before it gets better, and that might spook the markets a little bit there as well. So in other words, just be cautious. Even though you have bullish postures here, it doesn't necessarily mean that we're out of the woods. After all, you can see that we have falling moving averages in all four of these charts cases here. You can see that the NASDAQ held up reasonably well today. It was only down 0.95% today, whereas the S&P 500 was down 1.6% today. One of the things I shared with my students in my top-down trend trading class yesterday is that on the sector selector, which many times you guys can find on Twitter as well. So if I were to pull up Twitter here, you can see that on the sector selector, technology actually overtook staples on a week-over-week basis. If you're a premium member, of course, you have access to the full sector selector, including the bottom graphic that shows you all the stocks that are having extreme movements. But this will at least give those of you that aren't premium members a general sense of what's happening with sector rotation. And technology itself has been fairly resilient. A lot of people out there spending money on not only equipment, as a big portion of the workforce is now working from home and may not have had the proper equipment to work from home. So a lot of technology spending as a result of that. But then in addition to that, we've been hearing from companies like Microsoft out there that have been saying that cloud computing revenues have been surging in the last 3 or 4 weeks as a result of so much more bandwidth being used, whether it's because of everybody streaming their Netflix movies more often than they would if they had the opportunity to go out and enjoy a social life in the past, and maybe they're cooped up at home and watching a lot more videos and things like that. So anyway, cloud computing holding its own there as well, and of course healthcare doing reasonably well with some of those stocks like Regeneron that I had mentioned previously. So anyway, that did catch my eye, that the NASDAQ seems to be holding up a bit better than some of those other areas, and that might be as a result of a little bit more of a technology-focused index. Let's go ahead and take a look at our next chart setup now, and this will be our 3 green arrows chart setup. As it stands right now, we still have a mixed bag. In other words, we don't have 3 green arrow signals. We don't have 3 red arrow signals. We have a mix of them. For those of you that are newer, remember that if you're looking for 3 green arrows in the common vernacular out there, you're probably not going to find it. It is something that David and I are a little bit more familiar with as a result of the prior company that we worked for. But just a quick reminder in case you're not familiar with that. 3 green green arrows is effectively looking at three different technical indicators. You're looking at your 30-day moving average, you're looking at your MACD histogram, and you're looking at your stochastic reading. And whether the signals are bullish or bearish will determine if the arrows are green or red, with obviously bullish indications giving us green arrows and bearish indications giving us red arrows. So as an example, with the S&P 500 up here, you can see that we have a green arrow on the MACD histogram telling us that we have at least a short-term burst of momentum that has occurred over the last week or so. We also see that the stochastics is giving us a green arrow, telling us that we have started to close in the upper half of recent ranges, and that is usually a sign that the bulls are in control of the market during that time period. So over the last week, you can see that the bulls have largely been in control, and closing prices have been more often than not at kind of the high end of their ranges. But where we do have a problem still is the moving average. You can see that the last arrow that we had with the moving average was this red arrow that was way back here on February 24th. And so in other words, we've had an entire month where that red arrow has been established and has continued throughout. In other words, there has not been a pop back to a green arrow. That can only occur once price gets above that 30-day moving average, and they've got work to do, right? So far, we haven't even touched it. A lot of times you'll go up, you'll touch it a couple of days, and then it'll determine whether it wants to break through or if it wants to use it as resistance. We haven't even touched the 30-day moving average yet because of how violent that move was to the downside there. Just in 1 month's time, the S&P 500 is down about 16%, and that includes the very big bounce that we've had over the last week. So because this was such a violent move so quickly to the downside, kind of in the middle of March there, the 30-day moving average is kind of slow to react. And so we'll see what happens once we start testing that, if it is to occur. But right now, be aware that it does seem like we've seen more sideways movement in the market the last, let's call it 4 sessions or so, and those really big up moves that we had during this period right here about a week and a half ago have kind of given away to more of an exhausted feeling out there, like the bulls kind of had their run, and it may very well be time for the bears to take over here yet again. So we'll all be waiting to see if that happens or not, and of course we'll help you identify that on a daily basis during these videos here. Let's go ahead and now take a look at our next charts, and for this we're going to go ahead and take a look at some 12 grid analysis. So as we've got this pulled up here, you can see there's a little bit of a mixed bag out there depending upon what asset class you're looking at. The top 3 on the board are stock-oriented asset classes. We got the S&P 500 or U.S. stocks here. We've got EFA right here. That's going to be your developed foreign markets, and then you got EEM here, which is your emerging foreign markets. All of them kind of look similar to one another in that they're all down about 20% in the last 3 months, and they all are currently trading with a weekly bullish intermediate posture. Again, that light green background color signifies that. But they all 3 are trading below their falling moving averages, which is why those moving averages are colored red right there. So the point is, it's not a clear posture that we are dealing with right now. It's not cut and dry. There are considerations on each end, and there's a lot of confusion out there because there are so many unknowns left with this virus and how the economy will respond if and when we get past the virus, which is still a more optimistic conversation right now because we haven't seen any solid evidence that we are on the cusp of getting past this virus, at least here in the United States, as just today, you're seeing some of the worst death numbers out of New York City specifically, and there is some conversation that places like New Orleans and Miami are going to have worse days in front of them as well. Now, there's also the other side of the coin where we've been hearing more positive data out of Washington and California. So, we just have to remember to keep an open mind. Usually people who are hardliners in nature and have a very strong opinion of one thing or another are being driven by their political party. And so as traders and capitalists, we have to do our best to try to think rationally, absorb the data and the news that comes in, but not get caught up in the politicization of that news, and make sure that we're doing our best to keep our eye on the ball here in the stock market itself. And right now, we've got some bumps and some bruises after what has occurred in the last month. And as I mentioned before, it is my expectation that we're not done with that pain, and that we will have to experience more pain at some point in the future. But I could be wrong as well. And quite frankly, I hope that I am, as I'm somebody who owns a lot of stocks, and I would love to see them go up. It's just that I'm preparing my own mind for further price pain here as we head towards the summer. In terms of some of the other charts that have caught my eye, one thing that has been surprising about this entire kind of last 2 or 3 weeks is that gold has really not performed up to the expectations that I would have had, and we're all going to have expectations that don't pan out the right way. And I would have expected gold to be doing reasonably well in times of chaos, in times when we are launching multi-trillion-dollar stimulus packages here in the United States, and that just simply isn't the case. You can see here that GLD was down 3% today. Not only that, but after a big, nice rally back up above that moving average, where I was somewhat crossing my fingers and optimistic that we're going to establish a new base there, this is giving us a sign that gold is just not having it. And we have to recognize that and be realistic with what our expectations are. We can certainly have the right to think one thing as a trader, but price action dictates whether you're right or wrong. And right now, my prior expectation of gold holding up reasonably well in this environment is just wrong. And you can see here that GLD crossed down below its moving average. Its moving average itself turned red. Not only that, but the background color of the chart is pink, telling us that we now have a weekly bearish posture on gold. And I was looking at not only GLD with the bullion prices, but if I were to look at some of the mining companies as well, so let me maximize this so you guys can see this a little bit better. So this is GLD. This tracks the price of gold itself. If you wanted to look at the gold mining senior companies, or the larger companies, that's GDX, you can see that we've actually had 4 straight down sessions for GDX. Remember, the stock market itself isn't even down 4 straight sessions. So these gold mining stocks are relatively weak right now. And if you look at where it bounced down from, it was like kind of a picture perfect bearish trade setup there, where you have this lower highs and lower lows breaking down in a big way. You have this massive reflex rally, and lo and behold, where does it run out of breath? Exactly at that downtrending 30-day moving average. 4 straight days to the downside. So that's not a good sign for those gold mining companies there. If you wanted to look at the junior gold miners as opposed to the seniors, you could look at GDXJ, and it's equally as bad. In fact, maybe even considered a little bit worse. And the reason I say that is the reflex rally in GDXJ didn't even come up to allow it to touch the downtrending moving average. It kind of faded prior to that. And then you can see how the background color of this chart is that darker shade of pink, letting us know that not only do we have a bearish posture, this is considered a strongly bearish posture here. And the reason for that is this intermediate line is now trending lower and below 50. So the junior gold miners look even worse. And then if you were to start looking at a few of just the typical large and well-known companies out there, here's Newmont Mining. That one doesn't look too terrible. Remember, that's the only gold mining stock in the S&P 500. There's not a whole lot of big gold mining companies that are headquartered in the United States. This is one of them. So that one actually looks a little bit better than some of the other charts out there. One stock that was really popular last fall was KL. This is Kirkland Lake Gold. And this one looks like it's setting up ready for a bearish trade opportunity there as well. And then even the gold royalty companies like Royal Gold is kind of setting up with that same bearish possibility there, where it's testing that downtrending 30-day moving average, but it does not give us any confidence that it wants to burst through there. So if you're looking for bearish trade setups, surprisingly, a lot of the gold mining companies and even gold itself might be a decent place to look for some bearish setups there. All right, let's go ahead and get back on track here. Did want to point out that we had a little bit of a pop higher in Treasury yields today, but we still find ourselves at a very, very historically low level right now. The 10-year Treasury yield is about 0.70 if you're going to round up there. And then also wanted to point out that the dollar was pretty quiet here today, basically just moving in line with the range of its prior candles there, so not a whole lot to report there. Oil, be aware that oil itself is down about 2/3 in the first quarter of 2020. I'm not sure if that's a record for crude oil, but you can imagine it's got to be one of the worst quarters in history for oil, being down over 60% in just 3 months worth of time. A lot of that wasn't just simply because of less drivers on the road as a result of isolation and quarantining from the coronavirus. Much of that is as a result of kind of the little skirmish between Saudi Arabia and Russia. So the oil stocks have definitely suffered the worst from a sector perspective out there. And speaking of which, let's go ahead and look at those sectors. These will be the U.S. kind of large cap sectors. Remember all of these here that start with X, like XLE and XLU and all those. They are part of the Select Sector Spiders fund family. And basically what is happening behind the scenes is the 500 companies on the S&P 500 are chopped up into 11 different sectors. And so each one of those 500 companies has one and only one place within these 11 ETFs you see in front of you. So it's a way for you to gauge somewhat cleanly what's happening from a sector perspective, but with a focus on the large cap segment. So this is not going to include small cap companies in here, but still gives you a pretty good feeling for what's happening with sector rotation. And as you can see here, there is an oddball in front of us. In other words, one of these charts does not look like the others, and that one is energy. And after what I just got done saying there about oil a second ago being down basically 2/3 or 66% in just 3 months, it shouldn't be a huge surprise that as you look at the returns from a 3-month perspective of all of these individual sectors here, that XLE is by far and away the worst. It's down over 50%. So had you invested in a basket of oil and gas companies at the beginning of the year, your investment value has likely been cut completely in half, which, when that happens with one individual company, it's pretty nerve-wracking. When it's happening with an entire sector, meaning that some of them are down even more than 50%, that is enough to scare you right out of trading if you have the wrong portfolio established during a moment like that. So really, really ugly there in energy. But let's be honest. Was there any good-looking moves anywhere? Not really. The area, surprisingly again, like I mentioned before, that survived this storm of the last 3 months the best was technology. You typically don't find that with big market meltdowns of past decades. Technology stocks typically went down more than the market. This is a different era. Technology is becoming more important to all of our lives, and they're actually standing up to this test quite nobly. And stocks like Apple and Microsoft that have led this market for years did not end up giving back as much as the general stock market in the pullback. So that's an impressive feat that they were able to perform there. You can see technology was down about 12% in the first quarter, whereas the next runner-up was healthcare. It was down 13%. A lot of those coronavirus plays like Regeneron and Johnson & Johnson and Gilead helped kind of hold up healthcare. And of course, you got stocks like Teladoc and some of these others, that Moderna, that have been doing quite well as a result of their direct interest in the coronavirus. The consumer staples would have come in third, as they were down about 13.5% in the first quarter. And, part of the reason they were able to maintain some strength, first of all, they are defensive by nature, but kind of like I was explaining to my dividend growth investing class today, where we had a head-to-head matchup in the consumer discretionary space. So if you're interested in that consumer discretionary head-to-head matchup of a couple of dividend aristocrat companies, those of you that are plus and premium members can access that recording on our Trading Rooms calendar right now. But anyway, one of the things that we talked about in that class today is how some of the staples have been able to hold up much better than other stocks as a result of all of this kind of crazy hoarding that's been taking place, whether it's over at Kroger or Walmart or Target, but people just, and Costco, loading up their carts with tons and tons of non-perishable foodstuffs to put in their shelves. And so I have a feeling there are going to be a handful of consumer staples companies that record quarterly earnings here in the next few months as a result of that. Now, a lot of that won't be sustainable in future quarters, so you do have to keep that in the back of your mind. But I think that's allowed those companies to hold up much better as a result of the unique nature of this market meltdown that we're all experiencing right now. And then utilities would have been the fourth best performer. You can see utilities were down about 14% over the last 3 months. A lot of that could have been because utilities were actually a leading group going into the coronavirus. Now, after the coronavirus news hit, they did go down equally as hard as the rest of the sectors out there. But because they already had a bit of a head start, I think it allowed them to kind of retain some value and perform reasonably well. Remember, they also get a benefit of falling interest rates, which had been kind of a trend for a while, regardless of the coronavirus. So those are your top four in the last quarter, or the first quarter, I should say, of 2020. Technology first, healthcare second, staples third, utilities fourth, and then dead last by a long shot was your energy stocks out there. All right, let's go ahead and get into our trade application example today. So first of all, before we leave this screen, just a quick heads up here that you see that the consumer staples do have a bullish posture right now, similar to the S&P 500. So both of them have weekly bullish postures. And as I showed you earlier on the sector selector as well, the consumer staples were in the top three there. So they're holding up reasonably well. So now that the stock market has gone back to that weekly bullish posture, I figured I better do a bullish trade here every so often, since all of my recent ones, or most of my recent ones, have been bearish trades. So we're going to do a rare bullish trade here today. But as I kind of mentioned in the intro, I'm going to give myself an incredible amount of margin of safety. So kind of brace yourself here. Some of you might not like the strikes that I choose, and that's quite all right. This is a market environment where I think it makes sense to try to be a little bit safer than you typically would during other market environments, just as a result of the unknowns that are swirling around us. So let's get into that. I'm going to come on over here and just bring up, first of all, I'm going to bring up chart 2A. This is our dividend stair-step chart. And I use this to kind of gauge where we're at from a historical yield perspective. And the stock that I want to bring up for our conversation today is Cisco. And this is not the technology Cisco. This is the food distribution Cisco. This is ticker symbol SYY. For those of you that have ever worked in a restaurant or a cafeteria or something along those lines, you probably will recognize this company. They're the largest food distribution company in the United States. Now, that is generally an incredibly boring business. It's one of the most boring businesses that you will ever stumble across. That all changed this year. So you can see this is a 10-year chart that we're looking at here, where this stock on occasion has entire years where it doesn't move within, let's call it a 20% band. Sometimes it'll just go sideways for months and months on end, and it'll be like watching paint dry. And then eventually it kind of kicked into high gear. You can see in the early part of the decade, of the last decade, it spent more time below the blue dividend stair-step line. And in this chart's case, the blue dividend stair-step line is a yield of about 3.31%. So more times than not, from about 2010 to 2015, you would have had an opportunity to buy this with a 3.31% yield. In the second part of that past decade, you'll see that it had a little bit of a shift. And this stock, for some reason, started to gain favor amongst traders and investors. And this stock started taking off. You can see it ended up coming into this orange zone above the orange line, telling us that its yield was less than 2.71% on average for the last decade. And so at this point, we would have considered this company to be overvalued. Now, it had been overvalued for a long time, and that can be aggravating as well, so you got to stick to your principles. But you can see in a case like this how quickly the storyline of any given company can change. And boy, oh boy, did this one change in a big way. This stock basically hit an all-time high at about $86 right here in the final week of 2019. And starting this year, it has been nothing but a disaster, as the stock has gone from $86 at its high all the way down here to $26 at its low. Some of you might be wondering, how in the world is a very boring, food distribution company like this that has 50 years in a row of dividend increases going to fall from $86 to $26 in 3 months? And the reason behind it, or at least the perception, is with all the restaurants basically boarded up for all intents and purposes here in the United States. Yes, there is takeout and drive-through business, but a lot of the sit-down restaurants are boarded up right now in this country as a result of social distancing. And there is, some very significant fear out there that Cisco, that has 50 years in a row of dividend increases, might now have to consider cutting their dividend. And that's causing some concerns and some worries that this company that had established itself as a dominant player in its niche industry for a half a century is now just on the precipice of disaster. I think right now we're a little bit too early in the game to determine that. I do think it's a realistic possibility, so I don't want the takeaway of this conversation to be that I don't think that they will cut their dividend, because I do think that it is a legitimate chance that it is possible. It's just that I don't think they're going to make that decision soon. In other words, in the next 2 months or so. I don't think they're going to throw away a half a century's worth of dividend increases just because they got caught behind the 8 ball with this virus. Now, if this virus doesn't get resolved and we're ordered to stay in our homes for the next 9 months in this country, then of course they might have to relent as they do a lot of business, not only with restaurants, but also schools. Remember, schools are closed right now, and ballparks, all the ballparks are closed. So, wherever you get food delivered for cafeterias and restaurants, you typically are going to have Cisco be a big player. So without a doubt, their business is getting damaged right now, and it might very well lead eventually to a dividend cut. But the bet that I'm going to make today is a bet that they're not going to do it in the next 17 days. And therefore, I don't think this stock is going to fall 44% in the next 17 days. Now, the reason I'm using those numbers is because over here, we're going to look at the April contracts that have 17 days left until expiration. These are the monthly contracts for the month of April. And I'm looking at the $25 strike put. This is going to allow me to receive a 1% return on risk, which is typically what we will shoot for in some of my put selling classes. What this market environment has allowed for, because the VIX has skyrocketed higher, is for us to sell premium on generally quite boring and mundane businesses at strikes that are ridiculously far away. And that is the case here. You can see the return on risk on this trade right now is about 1.25%. Now, some of you might like this trade, but you want to be, a little bit more aggressive with it. Maybe you sell some of these other strikes in the 30s. But again, because of the very precarious nature that we find ourselves in here, I think it's better to play it safe rather than sorry. But with this company having 50 years in a row of dividend increases and currently yielding almost 4% as it stands right now as a $45 stock, if it were to fall down to $25, that yield would go up, around 6% or whatever it would be at that point. And I'm basically making the bet that that is not going to happen in 17 days. By selling these puts, I will be able to capture probably 25 cents here. You can see the last traded price was 30 cents. So it is a realistic expectation that I could get filled at 25 cents as soon as tomorrow on this and capture my 1% return on risk. Basically, the bet that I'm making is that this $45 stock is not going to fall down below $25 in 17 days. Could it happen? Of course, anything is possible, but I think the chances of that happening are probably pretty small. And if they do happen, then I am still reasonably interested in this company because of its long history of dividend increases, so I'd be willing to pay the ultimate price. In other words, I'd be willing to buy shares of this company at $25 if it came down to it. But I personally don't think that's going to happen, so I think that the greater likelihood of an outcome would be that this company does not fall below $25 in 17 days, and therefore we just merely get to keep the premium that we take in when we sell that put. So I'm going to click on the bid price here. I am going to do 4 contracts here just to juice it up a little bit more there. And again, I am going to put this in for 25 cents, which I probably will get filled on tomorrow. So I'll just leave that in as a day order here. Since the last traded price was 30 cents, we might even get filled at 30 cents tomorrow. Last I checked with the futures, we were down just a touch. But I'm going to go ahead and click confirm and send there and send that in. And we're going to basically take in $100 to be willing to buy this stock at 25 bucks if it's trading there in 17 days. So a way that you could think about that would be like setting a buy limit order on that company to buy it at 25 bucks, but you're getting paid $100 in order to place that trade. So I'm going to go ahead and click send there. And then the last thing I want to do really quick here is just pull up chart for A and just show you that it does have a bullish posture right now. So again, to kind of keep with the theme of the market having a bullish intermediate posture at large, this is a company that you could enact technically a bullish trade example and kind of follow that routine of taking bullish trades when the market has a bullish posture and then vice versa. So a rare bullish trade for me here tonight, but one in which I'm still nervous about the overall market and want to give myself a tremendous margin of safety where the stock would have to fall over 45% before I would start seeing some damage on that trade. All right, with that, I want to wish you all the best of success with your trades and your investments. Remember, if you got value out of this video, make sure you go over to Twitter, click like and retweet there for us, and then David will be back in the saddle there for you tomorrow. Take care, everybody. Bye-bye.